Okay, wow, was I ever wrong on this one? The Bank of Canada unexpectedly increased interest rates to 4.75% today, which was a huge surprise for the markets because over the last couple of years, the Bank of Canada has been very clear in messaging what they were about to do next. And this time around, they did this completely unexpectedly. Although it was expected that interest rates were probably going to go up in the summer, it wasn't expected that they would do it this soon. Maybe a small piece of the market thought that, but the majority of the market had just expected that they would continue doing what they do, which is communicate what they're going to do. And the only thing that can be drawn from this as a conclusion is that the Bank of Canada thought they needed to do something unexpected, show that interest rates weren't going to come down anytime soon, and talk a little bit more about the fact that interest rates are going to go up even further in order to get people to stop spending so much money and quit putting upward pressure on inflation. Now, as a result of the surprise interest rate increases, bond market yields went up substantially by 0.2%, which means that fixed mortgage rates are about to go up as well. Because anytime the bond market yields moved, so too do fixed rate mortgages. So we're going to see increased pricing on variables and on fixed rates, and it's pretty much going to happen immediately, which is surprising considering that a lot of people thought that interest rates were probably going to come down before they went up. And there's more to this story, because not only did the Bank of Canada increase interest rates, but they also signaled that more interest rate increases could be expected. And several economists pointed out early this morning that they are now expecting that there will be another interest rate increase in July. And as you can see from the headlines, not only was this unexpected, but it changed the sentiment with respect to the direction of interest rates almost instantaneously. So let's talk real quick about the reasons for this change. First and foremost, the job market is remaining tight. And even though there's immigration, even though there's lots of people coming into the country, they're getting hired relatively quickly. And on top of that, growth in the country remains high. The most recent GDP numbers surprised on the upside. So basically what we have is an economy that continues to run at full steam, a labor market that continues to run at full steam, and those two things will ultimately lead to inflation potentially remaining sticky. And that's the big concern here, is that inflation remains at 3 or 4% rather than getting it back down to the 2% range. So central banks all over the world are looking at this and they're saying we probably need to increase interest rates further if we want to see those inflation numbers come back to 2%. Now, there's a whole bunch of different storylines that we can go down here. There's the government storyline with the conservatives and the liberals fighting over what's responsible for inflation. Of course, the conservatives are suggesting it's the spending of the liberal government, which probably has some effect. And the liberal government is pointing to COVID and how quickly the economy recovered, along with the war in the Ukraine. And regardless of what your politics are here, the reality is there's a whole bunch of things that have contributed to high inflation. And the Bank of Canada governor, I don't envy him for a second, has a really tough job trying to get inflation back to 2%. And making decisions like this to quickly move interest rates is just part of the game of trying to get inflation back down to 2%. Sometimes you have to do what's unexpected and surprise the market and change sentiment very quickly in order for those changes to make an effect. Now, the other storyline that we can go down here is the fact that interest rate decreases by the end of the year are simply just something that don't seem to be on the table right now. And I've been wrong before. Obviously, economics is a game of making a prediction and then seeing if you're right. It's all about hypothesis. But I think it's safe to say that interest rates coming down anytime soon is something that is getting further and further from the minds of Canadians. And even if they do come down, they'll probably be coming back down to the rates where they're at now and not the rates that we saw in the last couple of years. Because as of right now, as of today, interest rates are now the highest they've been since 2001, 22 years. And here's what that means for you. It means that you need to get a little bit more conscious about how you're spending money. In fact, you should probably spend as little as possible, especially on discretionary items. It also means that you should get real conscious about your job and making yourself indispensable to your employer. Because at some point, as interest rates go up, there is going to be a moment where employers look at the numbers, look at the data, and realize that they've overhired and that they're going to need to cut back. And the people who are the most valuable are the people who are going to remain employed. The people who are the least valuable to the company, so in other words, the ones that are dispensable, are going to be the ones that are eliminated. And as of right now, I'd be watching those job numbers. I'd be watching to see if companies start doing layoffs. I'd be watching to see if companies stop hiring as quickly. And then I'd be thinking about that with respect to my own personal finances and whether or not I have an emergency fund set aside, whether or not I have the right mortgage, which for many people could be a fixed, for some it could be a variable. Although given where the numbers are right now, it is seeming like fixed rate mortgages are the better choice, especially given the wide gap between them and variable rates. And we use that same logic that we've used all along, which is you always take the mortgage that you can get at the lowest rate at the time you get the mortgage. And right now, those fixed rate mortgages are priced significantly better than variable rates. And I talk about all of this in my book, Mortgage Secrets, where we discuss exactly how to choose between fixed and variable rates and how to make sure that you don't end up with a discount mortgage. And just keep in mind that this is all about risk tolerance. If you're the type of person who wants to ride it out and see where it's going to go, by all means, choose a short-term rate or a variable rate. But for most people right now, it seems like fixed rates are the best option because who knows how long these interest rate increases could go on. It could be quite some time. And if there's any lessons to garner from this, it's that the Bank of Canada, the Federal Reserve, and other central banks around the world will do what they need to do to bring inflation down. And that means there could be more surprises ahead. So a good exercise for people with respect to their mortgages and their finances is look at what the absolute worst case scenario could be and then plan for that. Because if the worst case scenario happens, at least you're prepared from a risk tolerance perspective. And if the best case scenario happens, well, then you end up winning a little bit as a result. Oh, and if you want to check out the latest information on what's happening in the real estate market, make sure you check out this video right here.